October starts tomorrow, historically Bitcoin's strongest month of the year, and the setup is impossible to ignore. ETFs and treasuries are stacking relentlessly, gold is ripping, and the dollar looks primed for a multi-decade decline. This could be the final warning before everything changes. What if the halving cycle has been dead since the 2017 top? And what would a fourth straight year of upside do to investor psychology? In this episode, I'll lay out the clearest case yet that Bitcoin is in the early innings of a true supercycle, and why the next year could change the way the world views Bitcoin forever. Welcome to No Second Best, the show where conviction meets reality, and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. On the heels of October, Bitcoin is still consolidating near six figures, hovering around $114,000 today after nearly a full year in this range. At the same time, gold has broken into new territory again this week, nearing $3,900 per ounce. The sound money trade is alive and well, but gold is currently setting the pace. And that makes Q4 absolutely pivotal. October is historically Bitcoin's best month, and many of the lingering questions about its market structure will be answered as we move through the year end and into 2026. For all intents and purposes, Bitcoin is on the verge of a major psychological shift in its adoption. For over a decade, Bitcoiners have anchored themselves to the halving cycle thesis: 3 years up and 1 year down. But what if that model has already expired? What if macro forces, ETFs, and institutional adoption have already rewritten the script? Joe Carlasare and James Check, better known as Checkmate, joined What Bitcoin Did to talk about the 4-year Bitcoin cycle meme.
I've said this publicly for well over a year and a half now. I think it is a mistake to attribute the peak and subsequent drawdown in late 2021 and 2022 as a Bitcoin idiosyncratic feature, okay? To me, it's not simply coincidence that Bitcoin peaked in November of 2021 alongside numerous other risk assets, that it was coincident with the telegraphing from the Federal Reserve that they were behind the curve and they would be in one of the fastest rate hiking cycles in history, dealing to the rapid onslaught of inflation, rolling off their balance sheet, QT, et cetera. I just think it's simply implausible to suggest that was a Bitcoin idiosyncratic feature. It just happened to line up with the majority of macro chaos that we had to go through most of 2022. So my view has been that even predating the 2021 cycle, I think the cycles were dead if they ever were a thing, driven by some halving supply demand dynamics. I think that wasn't a coincidence also that alongside Bitcoin ripping, you had many other risk assets ripping through most of 2021 that were drunk on the high of the stimmy checks and the ZERP and massive central planning easing. So my view is that these are ex post facto the narratives we develop to justify why price action develops. And to me, right here, I think it's very simple. If the economy remains robust, potentially reaccelerates, I expect Bitcoin to do well. I expect most major risk assets to do well. And the opposite is also true, right? If the economy continues to decelerate, if some of these weaker segments of the overall economy start to get worse and potentially bleed over into other sectors, I expect the greater risk asset complex to struggle alongside Bitcoin.
I fully agree. And I think I've had this line I've been floating around recently. People are going to hang on to past cycles, past their use by date. And they're also going to throw out certain patterns thinking that, it's already broken. So I'm living in a very flexible world in terms of how I bring data into my system. Because if you look at the past cycles, really there's been two major regime shifts. I wouldn't really call them cycles, but a period in time where market structure absolutely changed. The first one was the 2017 top. After that 2017 top, it stopped looking like this retail, very just like organic type dynamic. Stablecoins come in, derivatives come in, leverage comes in. That 2018 through to 2022 period, for those of you who lived through it, I call it Schrodinger's Bitcoin. It was both alive and dead. The regulators were going to kill it. TradFi had written it off. There's a bunch of hodlers who still believed in it. There's degenerates gambling on this thing with leverage. Then we got the stimmy checks and everything in 2021. And when FTX collapsed on 2022, you can look at any metric you want, whether it's price relative to the 200-day, any on-chain metric, they all change pattern. At the 2017 high from a very organic retail-driven thing, that middle period, boom, bust, just straight up, straight down. And then from 2023 onwards, super stable, super structured, looks a lot more like 2016, 17, but things take a lot longer to play out and they don't have the big drawdowns. So they're the kind of zones where market structure changed. And there's a lot of different components to that, but I generally agree with Joe. People like to fit a narrative to explain it.
I'll just tell you, from when I say this, people tend to hear, oh, it's a super cycle. Bitcoin will never go down. There'll never be a correction. I'm not suggesting that at all. Like Bitcoin can obviously pull back and it can have drawdowns, right? But this sort of predictable 4-year boom bust cycle that we have to go on that's coincident with the halving, I think that's always been more of a meme than anything else.
The key point here is that the old playbook doesn't explain today's market. Bitcoin now trades within the larger liquidity cycle, macro conditions, policy shifts, and institutional flows, not just the halvings. And if that's true, the next question is investor psychology. What happens when the 4-year rhythm breaks completely? Joe Carlasare explains why the shift could completely change how people allocate to Bitcoin.
For as long as I've been in Bitcoin, this idea of the 4-year cycle has been this sort of ball and chain, I think, on the Bitcoin price. And Bitcoin is extremely sentimental, as we all know, right? Up 5%, we're all going to make it. Down 5%, we're headed to Goblin Town. If you can break the back of this 4-year cycle, I'm just telling you, I think that changes fundamentally the market structure in Bitcoin. It changes investor allocation. I mean, even right now, anecdotally, I'll tell you how many people, I was playing poker the other night, and a guy who's owned Bitcoin said, yeah, I'm probably going to sell a little bit going into the Q4 of this year because it's a halving cycle and Bitcoin's going to tank next year. And if you were able to rid this sentiment of the market and push it more towards like an equity market, where I don't hear that at all in traditional finance. Nobody talks about a 4-year cycle for the S&P. Obviously, there are liquidity cycles and recessions, et cetera. But if you can get rid of that narrative, I think that has very profound implications for how Bitcoin will trade into the future. That's going to be fascinating. And the most fascinating thing is it comes against the backdrop of that Fed independence potentially weaning or the curtain being pulled away from in the early part of next year. That's not that far away. It'll be into the early part of next year. You'll probably be getting an announcement of a new Fed chair. Besson said it was potentially November or December that they were going to give that name out there. And then the confirmation hearings will start, obviously, and you're going to have somebody taking over for Powell in May. That is almost like a poetic backdrop for Bitcoin and where it's at in its cycle. So hopefully we can crack that.
What Joe is pointing out here is profound. For more than a decade, Bitcoiners have lived by the calendar. 3 green years and 1 red year. That rhythm has become a ball and chain, as Joe aptly puts it, shaping behavior whether the fundamentals justify it or not. If we do get a 4th year of upside in 2026, it won't just be another bullish run. It would shatter that mental model. Suddenly, Bitcoin looks less like a speculative asset and more like a structural allocation, just like equities or gold. And that's where we need to zoom out, because this isn't just about trading psychology, it's about where we are in the broader arc of technological adoption. Mark Moss puts it well on the Bitcoin Archive podcast. Bitcoin is crossing the chasm and entering the steepest part of the S-curve.
We're literally still at this point in time where you have Larry Fink, the largest asset manager in the world, saying to buy Bitcoin, and Ray Dalio, the largest hedge fund in the world, saying to buy Bitcoin, and President Trump, the president of the free world, saying to buy Bitcoin, but your cousin's still telling you it's a scam coin. So we're crossing the chasm right now, and then the early majority and the late majority will come in. So I think that's where we're at in the cycle. Now we can take that diffusion of innovation, we can overlay that to this 50-year cycle, and then there's also, in technology, we use something called an S-curve. And an S-curve measures how fast the innovation gets diffused out to the public. And so the way an S-curve works is the time it takes to go from 0 to 10% is the same time it takes to go from 10 to 90%. 80 to 90% is typically considered full adoption. Still some people that don't use the internet today. So where we're at, I believe, in this 50-year cycle, we're just going into phase 2. We're about 14 years into it right now. Overlaid with the diffusion of innovation, we're just crossing the chasm right now before the early majority comes in. And when you overlay that with an S-curve, we're just going into the parabolic part of the S-curve. And we can see this through a lot of different ways. That's how we measure technology. But now let's talk about, like you mentioned, the politics, right? So Bitcoin has done what it's done in spite of being attacked by governments, in spite of the Biden administration's Operation Checkpoint 1 and 2.0, for example. It's done all of that in spite of that, with massive, what we'd say, headwinds against it. Now those headwinds went to tailwinds. Now we have, you mentioned left and right in the government. I would just look at it a little bit differently. We have the full government backing at this point. SBR, a sovereign wealth fund, Trump himself buying Bitcoin. Yeah, the states, et cetera. So we've gone from a headwind, and now we've gone to a massive tailwind, pushing it farther. At the same time, what happens is in the early 2 stages, because it's a retail move, we have people with thousands of dollars or hundreds of thousands or millions of dollars coming in. Today, we have billions, tens of billions, hundreds of billions coming in. So we've gone from small checks to big checks. We've gone from illegitimate to legitimate. We've gone from massive government headwinds to tailwinds. And that's what pushes us up into the parabolic part of that S curve. And so I think over the next 10 years, we'll go for a 90%, 80% adoption, which is a massive parabolic move.
And that's what the S curve is all about. Adoption going parabolic as Bitcoin moves from niche retail holders to mainstream institutions and sovereign players. And it's happening against a macro backdrop that could fuel it even further. And that brings us to Matt Cole on the latest episode of the Hurdle Rate podcast, where he explains how a weakening dollar could set the stage for a true Bitcoin supercycle.
I think the Bitcoin gold chart is probably what I think is the most important chart. But then the second most important chart in my view is DXY. And this line here, if you looked at this decline in DXY here, this was the 2017 bull run in Bitcoin. So basically, it was a bear market in DXY that correlated with an up move in Bitcoin. 2020-21, here you see April 2020, it's at a high. It sells off into 2021 when Bitcoin goes up. If you just look at the magnitude of these moves, they're pretty small moves, but yet they were very correlated with Bitcoin moving up as the dollar was devalued. If you look at it losing this historical support that turned into resistance to the downside, I think there's a decent chance that we could move substantially weaker. And part of the reason is not just because of a chart, actually. It's because literally the president of the United States, Donald Trump, has said he wants to weaken the dollar. And so when I talk about a dollar in DXY sub 70 range, while it's at 97, that might seem crazy. But if you look historically, it was at 70 in 2008. It was at 78 in 1992. It's been substantially lower historically than it is right now in a multi-decade downtrend. And so it's not actually in any way saying the dollar is going to collapse, because the dollar didn't collapse in 2008. It didn't collapse in 1992. What it's saying is that when the president of the United States wants to weaken the dollar, when he's taking very drastic steps that I think make more explicit the lack of independence at the Federal Reserve, and you have a debt crisis in this country, that it's not a crazy thing to say a weaker dollar. Now, if the dollar were to go down any level in this orange line, and you compare that to these other bull runs and the decline of the dollar, we're talking about an order of magnitude larger move in DXY than Bitcoin has ever experienced, not than the dollar's experienced. And look at these moves here in the 1980s. Look at this bear market in the early 2000s, 2008. Like, these sorts of bear markets have happened in the DXY before. If that happened, what would that mean to Bitcoin? I think the answer is, in my view, the argument of a supercycle, what a supercycle would look like. Because I don't think that there's any other scenario, if you actually saw that type of weakness in the dollar, than a Bitcoin supercycle.
And this is where all the threads come together. A structural shift in market cycles, a change in investor psychology, a parabolic adoption curve, and a macro environment with gold surging and the dollar weakening that could provide rocket fuel. That's not just a setup for another halving cycle, it's the setup for a legitimate supercycle, where Bitcoin gets re-rated higher year after year with shallower drawdowns and deeper conviction. So if you can see what's coming, now is the time to get your strategy right. Institutions and family offices are already positioning for this shift, and that's where Swan Private comes in. The Swan Private team works with over 5,000 clients, helping them build generational Bitcoin wealth with concierge service, airtight custody, and inheritance planning. Learn more at swan.com/no-second-best. And finally, a quick shout out to Mara, the world's largest publicly traded Bitcoin miner, for supporting this show and for helping make Bitcoin the world's most decentralized and secure monetary network. So here's where we stand. October, Bitcoin's strongest month, is just about to begin. The halving model looks broken. Investor psychology is changing. Adoption is surging, and the dollar looks ready to weaken into multi-decade lows, while trillions of dollars hunt for sound money. This may be the last quiet moment before Bitcoin's next great repricing. Whether you call it a supercycle or simply the structural maturation of Bitcoin, the implications are the same. The future no longer runs on 4-year memes. It runs on fundamentals. And those fundamentals point straight up, forever. But now I want to hear from you. If Bitcoin delivers a fourth straight year of upside, does it finally unlock the supercycle? Or do old habits die hard? Let us know in the comments below, like this video, share it with someone who risks missing the boat, and subscribe to the Swan Bitcoin channel for more high signal every single day. Thanks for watching, and remember, there is no second best money.